Okay, let's jump right into this explainer. Today, we're tackling a massive, honestly universal pain point for traders. I mean, we've all been there, right? You do the research, you time things absolutely perfectly, and you watch a fantastic winning trade just climb, and then you hesitate. You freeze up, and you watch that brilliant green turn into a heavy, unrecoverable red loss. It's incredibly frustrating. But you know what? It actually doesn't have to happen. Today, we're mapping out a concrete system, a real exit discipline that is specifically designed to protect your hard-earned capital. So here's the core of the problem. Almost every trader out there spends practically all of their time, energy, and analytical brain power perfecting their entry checklist. We're looking at fundamentals, screening charts, and waiting for that absolute perfect moment to hit buy. But the exit plan? Almost nobody has one. And this massive imbalance is exactly how good stock picks turn into bad, portfolio-crushing losses. You know exactly how to get in, but, well, you have absolutely no idea how to get out.
To fix this critical flaw, we are going to walk through an 8-rule exit framework. We'll be looking at 4 parts: the missing exit plan, trend and pattern rules, risk and context rules, and finally, building your exit contract. By the end of this explainer, you'll know exactly when to sell before the market completely forces your hand.
All right, let's kick things off with Section 1, the missing exit plan, and why you really need a mechanical system to overcome that natural hesitation. To build this system, we're using the concept of circuit breakers. Now, this is a framework adapted from the legendary exit discipline of trader Mark Minervini. Think about the electrical circuit breakers in your own house. What do? When a surge of electricity threatens to start a fire, boom, the breaker automatically flips. It shuts off the power instantly, with zero hesitation, to prevent your whole house from burning down. In trading, a circuit breaker is exactly the same thing. It's a predefined rule that triggers an automatic sell decision. It cuts your position before a small, totally correctable mistake spirals into a massive, unrecoverable loss that just blows up your trading account. Moving right along to Section 2, Trend and Pattern Rules. This is going to cover our first set of breakers, 1 through 4. Okay, breakers 1 and 2 are your core trend rules. First up, you absolutely must exit if the price violently breaks below the 50-day exponential moving average. The 50-day EMA is basically the standard institutional trend line. If a stock crashes through it on high volume, the whole character of that stock has changed, and you need to get out immediately. Rule 2 is equally critical. Exit if the stock rolls over into a dreaded Stage 4 decline. A Stage 4 decline means the stock has officially peaked. It's in a major, undeniable markdown phase. You simply do not want to be holding and hoping during a Stage 4 downtrend. Trust me on that. Next up, we have breakers 3 and 4, which are our pattern rules. Rule 3 tells us to sell into climactic parabolic price moves. You know, the ones when a stock suddenly shoots straight up at this totally unsustainable, exhaustive angle. That's usually late-stage greed. That is the exact time you want to sell into strength, securing your profits before the inevitable crash. Rule 4 triggers when a highly anticipated breakout just immediately fails. So if a stock breaks out of a beautiful, established base on the chart, but then instantly reverses and traps buyers, yeah, that's a massive red flag. The pattern has failed, the buyers aren't there, and your circuit breaker should flip without a second thought. All right, let's shift gears to Section 3, Risk and Context Rules, which covers our next set of breakers, 5 through 8. Breaker 5 is your ultimate hard risk rule, -6%. You absolutely must have a hard stop-loss limit, and for this framework, it sits at roughly -6% from your entry point. Think of this as your ultimate safety net. If a stock hits this number, you sell. No excuses, no waiting around for a bounce, and definitely no listening to your emotions whispering, "Oh, it'll come back tomorrow." You cut the loss at a manageable 6% so you actually live to trade another day. Now, breaker 6 pairs perfectly with that hard stop rule. You need to flip the breaker and get out when you see heavy distribution volume. So what does that actually mean? It means the stock is dropping on volume that is significantly higher than average. Listen, this isn't just retail traders taking a little off the top. Heavy distribution volume is a massive, glaring signal that large financial institutions, the real whales of the market, are aggressively dumping their shares. You do not have the capital to fight institutional selling. So when you see heavy distribution, just follow the big money right out the door. Rounding out our 8 rules are breakers 7 and 8 are context rules. These actually force you to look beyond the single stock and examine the ocean it's swimming in. Rule 7 commands you to sell or at least scale back your positions when market breadth is deteriorating, meaning fewer and fewer stocks are actually participating in market rallies. And Rule 8? It tells you to just step aside when overall market uncertainty is simply too high to trade safely. If the macro environment is totally chaotic, even the absolute best individual stock setups are likely to fail.
But here's the thing, just knowing these rules is completely useless if you don't actually apply them in the heat of the moment. So that brings us to Section 4, Building Your Exit Contract, where we focus on implementation.
Before we actually implement this, we need to clarify who this specific framework is built for. It's designed specifically for swing traders, momentum traders, and folks actively managing growth stocks. It's a precise decision tool meant to capture trends and cut momentum failures short. It's really important to remember this isn't some guaranteed financial advice magic wand, and honestly, it might not fit a decades-long passive dividend investor. But if you are trading momentum and growth, this discipline is absolutely your lifeline. So to actually put this into practice and protect your money, you need to create a fill-in-the-blank exit contract for your very next trade. Before you ever buy the stock, you sit down and map out your trigger categories, the specific circuit breaker rules, and the exact planned actions. For example, if it hits that -6% hard risk limit, well, the planned action is to sell the full position. If it breaks below the 50-day EMA trend line, maybe your planned action is to sell half your position to reduce exposure. If a pattern fails, you tighten your stop to break even. Writing this down creates a binding contract with yourself, and it completely removes dangerous emotion from your selling process.
As we wrap up this explainer, I want to leave you with a really provocative thought regarding your own trading psychology and history. I want you to be totally honest with yourself here. Which of these 8 circuit breaker rules do you break the most? Is it holding on past that 6% stop loss? Or maybe it's ignoring a failed breakout just because you really love the company's story? Pinpointing exactly where your discipline fails is the very first step toward ensuring a winning trade never turns into a devastating loss again. Take this framework, build your exit contract, and go protect your capital.